go. This is going now. It's our first presentation or webinar series about the 401k after a layoff, cash out, rollover, or leave it. Um, Being hosted by yours truly, Leah, Everly Rose Gold Signatures, and my beloved sister Courtney Davis. She is owner of Three Kings Tax Services. And we are going to discuss what to do with your 401k. Courtney, this is you. So I'm gonna let you introduce yourself.
Well, I am Courtney Davis, owner, like Teresa, my sister said, of Three Kings Tax Services. Been doing this, I guess about 14 years now. And I'm just here to pretty much kind of go over some options, as far as when it comes to withdrawing your money after retirement, or not retirement, I apologize, because this is about longer. I forgot what it was about. Uh, goodness. But whatever you have to do once if you get laid off, unfortunately, or if it's a situation like I personally had where our pensions froze and our company was pretty much selling it off to another company, so we had to do something with our money. So I'm going to go over all the tax options, how it can affect you in a negative way or in a good way. It depends on which route you decide to take. But that's me.
And then there's me. Um, she's gonna touch the tax services side, and I'm gonna come in on a financial strategy side as a life insurance agent and notary public. Um, since 2023. I started Rose Gold Signatures back in 2024, shortly thereafter. But coming from the 401k perspective, as a life insurance agent, the opportunities of rolling over your 401k is something I'm going to touch on. You can roll your 401k over to qualified accounts. For instance, people are very familiar with the IRAs. There are two different types. We'll touch on that. And then we have a product that's called an annuity. There are three different types of annuities. And then something that a lot of people don't really talk about, but using your IUL, an Index Universal Life Insurance, as another vehicle to roll over your 401k. And then we're going to talk about why you don't want to just cash out. You want to know all of your options. So we're going to talk about understanding those options, comparing your choices, those key factors to consider, making the right decision, and the next steps. And then, of course, at the end, taking action. And Courtney, if any point in time you want to jump in, just jump in, girl.
Okay, I got you. You're doing great though.
So, why this decision matters? So your choice today can impact your tax, retirement income, and your long-term financial security. Understand the differences and know the consequences, and make a confident decision that aligns with your goals. So you got to know if you're going to cash out, roll over, or leave it in, and know and understanding how that works. The key factors to consider is your goals. What are your short and long term goals? And then the time horizon, like how long until you need the money, the financial need. Do you need cash now, or can you stay invested? Then you got the risk tolerance. How comfortable are you with market risk? And then estate planning. Do you want to leave a legacy for your loved ones? So here are your options at a glance. You got a cash out option, which seems to be the very most popular option. People like the idea of cashing out that money. It comes out as a lump sum, of course. You get immediate access, but you do have to face taxes and penalties in some cases. But then you got those reservative people who don't want to lose their retirement. They want it to continue to grow, so they roll it over into another retirement plan that may offer better tax advantages and growth. And then you got those who just don't really know what to do, so the best option is leave it alone, right? No real immediate action needed, just kind of leave it there, but you do limit your options on how you can control your 401k. So this is the first option, cashing it out. I'm gonna let Courtney take over on this part.
Okay, yes, cash it out. That's usually the first thing people run to. Oh, I can get my money. It's a lot of emotional decision making, not really thinking about the long term effects, what's going to happen next year when you file your taxes. Well, just to let you know, when you cash out, yeah, it sounds great, but it does remove a lot of your retirement. So for the long term, it really hurts you more than help you. Now, a lot of people don't realize this, but you can cash out a portion instead of the entire thing. You can do this, you know, a whole bunch of different ways. But just to let you know, cashing out, you will be hit with a 10% penalty on top at the beginning. Before you can see a penny, it'll be 10% gone from federal. And depending upon what state you live in, you'll have state taxes deducted as well. But you usually don't have that deducted until you file your taxes. But you can opt to have those taxes taken out off top as well. But they just won't automatically do it. You have to actually ask for that. The downside is unless you're 59 and a half or older, you're going to get hit with that 10% penalty. It's an early withdrawal penalty that you get hit with if you file your taxes in February, March, April, you know, of that following year. Now, for those that are turning 55, the year that they are laid off, or 56, we'll just say 55, that year or any, you know, any older, obviously. You can possibly have that 10% waived. There is something called the Rule of 55 that will allow you to do that. But that only works with the employer plans. So if you have another retirement plan that doesn't work, it has to be an employer plan. So there are specifications that you have to go by for that to work. But ultimately, you have to keep in mind, you know, once you take that money, it's gone. So, for example, just to speak on numbers, let's say you have $50,000. You know, that's a modest amount, right? Well, $50,000 in a 401k. Some people probably have more than that if it's a pension, if they've been with the company for a long time. So you're going to get hit with that 10% up front, state taxes, and then, of course, that 10% penalty. You're looking at around about 31.5 out of $50,000. That's a lot of money that you're losing just for taking that money out. But you know, sometimes you know we're in situations that we have to take money out for something. It's something that's dire right now, but you have to look at it like that's just a short term fix. That's not going to help you in the long run. So once you are in retirement age, you're not going to really have any money because it's going to be gone. As soon as you have it in your bank account, it's really hard to not spend it for most of us. I know it is for me. That's why I put it in certain places so I don't touch it. And that goes into the next thing. Besides doing the cash out, we can do the rollover. Now, rollovers are popular as well. If you're someone who's wanting to hold on to your money, a rollover is going to be the best way. Again, it's tax deferred. You don't have to worry about paying any taxes, no 10%, no early withdrawals, none of that. Your money just rolls into another retirement account and it continues to build. Now, there's different ways you can roll over. I know Lee's going to help me with this.
Yeah.
You know,
Yep, yep,
rolling on
yep.
to that. But
Rolling on over to that one.
roll over. There's different ways you can roll your money over. You can do it in a Roth IRA, an IRA. You can, I mean, brokerage. I wouldn't go that route, but hey, that's you know, you can do what you need to do. But
Mhm.
there's a lot of that too, because some people withdraw their money and think that they reinvest it into a brokerage account, which is nothing more than the stock market. You're still gonna get hit with the withdrawal penalties just like before. That's a withdrawal. That's not a retirement account. Now, if it's an IRA brokerage account, which is usually managed by like Fidelity or Law, those type of companies, then yes. But it's all about how you do it, not what you do. All right, sis, go. Next,
Well,
and then
yeah,
what?
well, then piggybacking off what you said, yeah, I mean, so I will give this prime example about, using your money and putting it into a Fidelity brokerage account. Let's say, the thing like from an insurance perspective, you have a pool of money or a retirement plan and you wanted to roll it over, but guess what? You probably would not be able to qualify for instance, an IUL because you may have a background that prevents you from doing it. Maybe you're not too sure about the annuity. You want to have this ability to have access to your money. The IUL will give you that, but other retirement plans like IRAs and annuities, they don't give you that quick access to your money. Um, so unfortunately, and you can't have an IUL because of situation. So you go to the Fidelity brokerage account, right? And that then kind of gives you that feeling like you have that retirement plan set up and the access if you want to. But like sis said, it is risky because you're tapping directly into the market where, if the market drops, you're going to lose your money. And if it's going up, you're going to gain your money. But, it is the risk. But we're going to talk about the traditional rollovers here, the IRAs, the annuities, and IULs. Here's a comparison overview in which of what each one does. The traditional IRA is the primary purpose for retirement savings. It does have a market-based growth potential, but it does not offer income that's guaranteed. It is a high market risk product, and like my sister said, it is a tax deferred product, meaning that they don't tax you on the money until after you start using it as income. That's what tax deferred is. It is high in liquidity, and it is best for those who want flexible retirement savings. Comparing that to an annuity is a product that offers lifetime income. The potential of growth is fixed or indexed, even variable, to be honest with you. And what that basically means is um, it mimics the stock market, where the IRA is market based. This one will pretty much be linked to the market, but not in the market. So if the market is doing good on an index or a variable, then you have a higher interest rate coming into your money on compound interest. But if it drops, then with the index annuity, you have a floor of 0%. So you don't lose your money, you're just not making any extra money. But with the variable is different because it is more like the traditional IRA. So if you lose in the stock market, you lose in your interest rate as well. And in a lot of cases, more risky. Now, with the fixed, it's a safe measure because you have a fixed interest rate of maybe 4.5% or more, but it's going to always be that way no matter what the market does. Um, it is offering guaranteed income. Again, it is lifetime income, is what it's created to do. It also has a death benefit. So, an annuity is for those who, let's say, you might be 75 years old with a lot of different health conditions, and you have a pension or you have a 401k. Mind you, with the pension now, you have a 60-day deadline to roll it over into an annuity. But aside from that, let's say you got a 401k, you can roll that 401k over into your annuity, and it will provide you with lifetime income that's tax deferred. Um, it will also give you a death benefit if you don't use all the income. So if you don't qualify for a life insurance policy, then an annuity is kind of like a good substitute for that. Then you got the IUL, which is an Index Universal Life Policy. So it's a life insurance policy before it's anything else. And put that out there. Um, the primary purpose is to help build wealth and give you that protection for when you pass away. In case something happens to you, you got protection for your mortgage and your family. It is, like I said before, in debt, so it's market linked. It mimics the market, but it's not directly in the market, so it's not affected 100%. Um, it does not offer guaranteed income, but it does offer protection with the death benefit. There is some downside protection, a low risk, which is a good thing because it has a floor of 0%, so you don't lose your money. It also has tax advantages, and the liquidity of it is moderate, meaning if you choose to borrow money from your IUL, from the cash value account, it is highly recommended to use it from a loan perspective because then you get tax free money versus getting as a withdrawal that removes it from your account permanently, and it's a taxable event. And then also it's best for those seeking growth with protection and legacy planning. And here's just another graph for those who like to see it from a different visual, to show you kind of how it grows over a 20-year span. Mind you, this is not 100% accurate. It's just a prime example. That's all on some historical figures. But I will say, if structured properly, the IUL will outperform an annuity and an IRA if it's max funded. The reason it's not demonstrated because a lot of people who just don't have a whole lot of money in their pocket, they have to just do what they can. So it's not max funded, it's just funded enough to keep on for a lifetime. So in that case, it's not going to give you the biggest return. But if you're able to dump a lot of money in the first 5 years of an IUL and give it the growth it needs to accumulate that cash value, then it can outperform an annuity and a traditional IRA with interest rates that can go up to 12%. On this graph, it's showing 6%, an annuity at 4, and a traditional IRA at 7. So the traditional IRA versus the Roth IRA. I am going to let my sister talk about this. Why? Because I see tax, 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 tax.
Comparing the few. Well, it's not a huge, it's not a lot to say about, but with the traditional IRAs, you generally are continue like the tax deferred treatment, meaning that the taxes are paid later during the retirement withdrawals. A Roth conversion, though, that works a little bit differently because those are usually paid up front, the taxes. So you pay the taxes, but then you withdraw tax free. That's the biggest difference between those two for the most part. So it really just depends on, do you really want to deal with the taxes now or later? But they're both very, very similar. I prefer the Roth. I'll be honest with you, that's just what I prefer. Get them out of the way. That way I don't have to worry about taxes. Everything else is just tax free. Boom. And it's just building. What else you got on your slide? Okay. Oh, see, I didn't go through all the slides. Oh goodness. So okay, a little bit more detail. Yeah, office broad invest. That is true. That is true. Um, traditional IRAs maintain tax. Yeah, that's true. They have lower fees than some employer plans. Absolutely. It's always good to have your own outside of your company. I think anything outside of your company is good to have. I'm not saying there's something wrong with companies. It's just you have more flexibility with your
Hmm.
choices. Let's see. No guaranteed income unless combined with other strategies. That is true. That is true. I like that, Leah. My sister gives you. My sister gives people multiple options. It's not just one answer. Like you
Hmm.
can have that 50,000 and say, well, ooh, I gotta pay for this. I'm about to get evicted. Whatever the situation may be, I need 5,000. Okay, well take it. That's just 5,000, and then move the rest. So you can do that. You don't have to take it all. It's not all. You can do it however you want. Just if you can save as much as possible, that's always the goal. But life be life, as they say. So sometimes we got to do some things that we don't want to do.
Hmm.
But you know that's just the awareness of it all.
Now,
But okay,
I
yeah.
was able.
Uh huh.
It stopped recording, so it caught you
Who
at
did
the
it?
end. Yeah, when it
Well,
went
we
and
didn't
glitched
see it.
out. I know.
Sorry,
So
we bumped over
we
everything.
started on that little point that you were just making. But I
Mm-hmm.
did get the slide back up to the next one on annuities and which one is right for you. You want me to do that one, or you want to do it?
Thank you, girl.
Alrighty.
Alrighty.
Annuities is a life insurance product. Like I said earlier, you have three different types. There's a fixed variable index, and all that is basically how compound interest grows within regards to the stock market. None of these products are directly in the stock market except for a variable. So if you have a life insurance agent, they have to be licensed with securities in order to um, distribute or sell or write you a policy, be a life policy or an annuity pertaining to variable products. I do not do that. I'm not there yet. But I am in a circle of people who are. So if I ever have a client and that is their interest, then I would just send them that way. But in the meantime, I can help you with a fixed annuity or an index annuity. Um, let's see. Is it gonna let me? This thing freezes up.
But this is the first one, so trial and error.
Yeah, I I know, right?
Nobody's in here.
I'm telling you.
You can
So,
always change that. I don't like that. Let me take that out.
like bleep bleep. So this one is about the
Pretty much.
401k being rolled over into an annuity. So what does it do? It can provide that guaranteed lifetime income, tax deferred growth, which continues after the rollover. Where okay, so and sis, jump in with this one if you feel need to, but like with the 401k. When people retire, how often are you familiar with people saying they had a 401k, they retired, and then they ran out of money. So they went back to the workforce because they ran out
All
of
the
their
time.
retirement all the
It's not
time.
meant to. It's not meant to support you. That's
No,
never what 401k is for.
exactly.
That's what annuity is for, because that's a check you're gonna get up until, in most cases, the rest of your life. Um, and a lot of people don't know. Well, it depends on the. I'm not gonna go too many deep details. That's your world, because different types of annuities. There's some
Mhm.
where let's say you pass away, the money still keeps going to the next person. So I mean, there's but 401k is no.
Yeah,
It's
and
just a glorified savings account.
that's
That's all it
it,
really
and
is.
that's why a lot of people who think that they're okay with having just their 401k, well, you're not. Because you're gonna exhaust that money in your
It's gone.
retirement, and it's gone. So
Mm-hmm.
with the annuity, you can roll it over. It is a qualified product, and it does not cause a taxable event because you're not
Mm-hmm.
receiving the money. It's going from one product to the other. So
That's
therefore,
right.
it's not a taxable event, but it is tax deferred. And what that, that's a topic people don't really talk about either, about the advantages of money
Mm-hmm.
that's tax deferred versus tax upfront. So
Yeah.
like we know when you're working, you got a steady income coming in. You might have more than 30,000 a year. Well, that puts you in a 24% tax bracket, right off the top.
Mm-hmm.
If less than 1,000 in a year, you're at a 12%. So
Mm-hmm.
9 times out of 10, when you're in retirement, you've paid up all your bills. You're not making much money. You are living off whatever you get from your retirement. You're gonna probably fall below the 30,000, which is not a bad thing because you've already paid off all your debt, theoretically speaking, right? And
Mm-hmm.
if that's the case, wouldn't you rather be taxed at 12% versus 24%? So,
You would. You want to be.
yeah.
Unfortunately, though, because the Social Security, but it's not taxed, of course. But
Mhm.
a lot of people, even with pensions, they're getting taxed. But anyway, go
Mhm.
ahead. Go ahead.
Well, talk about it because I do have people who are, they have pensions with their Social Security.
Mm-hmm. Well,
So,
I mean, because Social Security is not, it's not taxed up to a certain amount.
mhm.
Okay, let me clarify that. To a certain amount. And I have to pull up the exact numbers, but once you hit that certain amount and then plus your pension, you are actually taxed.
Mhm.
That doesn't mean you can't get a refund. You can get a refund. Those laws still apply, but of course, when you're above the age of 65, anyway, you're going to get um, more breaks, that's per se, without going down the list of things.
Mhm.
But yeah, the pensions a lot of times are taxed, but again, that's because of the fact they're tax deferred. You're not paying for it up front.
Yeah.
It's back end. Once you start getting those withdrawals, you're getting withdrawals, but they're also being taxed as well.
Mhm.
And you still file taxes with your pension. Um, but again, you get that money back. So for some people, if you just get Social Security, let's say Social Security and a pension, 9 times out of 10 you're getting a refund. You're getting your money back.
Mhm.
But let's say you're someone who owns properties. Um, you're gonna, because of the fact you own those properties and the refund, a lot of times that'll help you out without owing any money. So it can go. Everybody's situation is different, but you're on the right page when it
Mhm.
comes to that, in the right path. I have to say.
So now
But
let's say, and let's just add this question. Say you are getting a pension, Social Security, or whatever.
mm,
Do you have to file taxes?
you do
Okay. No matter
on
what
that
is what
pension.
amount, no matter what the amount is.
On that pension, you do,
Okay.
because it's considered it's a disability. Well, Social Security is like a disability, right?
Mhm.
Even though it's not a disability, but it's treated the same way, just like military disability. You don't have to file. SSI, you don't have to file. Social Security is the same way.
Mhm.
But because the pensions are typically taxed, seen so far is tax. You still have to file taxes on that. Because your income, once you add it with the Social Security, is going to go over the level. Like I said, I'm gonna look at matter of fact, let me get them numbers, girl. I hate not talking about the numbers. Now I gotta get the numbers. I'm gonna pull up my little number thing.
And I asked that question because you don't know how many people out here may be in that position where they're getting pensions and they're not paying their taxes. I'm
Mm-hmm.
assuming, is there a tax, uh what's the word I want to use, liability for not filing your
Mm-hmm.
taxes?
Right, right.
Like,
No, I
is there
think
anything
that's
they would have to deal with later that might be very costly to them?
right. Okay, here we go. This is what I was looking for because it depends on several things, just like it does for me and you. You know, whether
Mhm.
you're single or married, these things all play into part too. So everybody, like I said, everybody's situation is going to be different.
Mhm.
So, for example, if you are single, not married, nothing like that, and this is based on your Social Security. Let's say you just get Social Security, it's below 25,000.
Mhm.
There's no Social Security taxes. No, you don't have to file anything, right? But let's say and this is for a single person, not even married. But let's say your Social Security is between 25 and 34,000.
Mhm.
Now you're taxed up to 50% of that Social Security, okay? Because it's based on how much you're making total. Because your Social Security is going to be different from mine. Because obviously it depends on how many years you've been working, how much money you've been making over the
Mhm.
years, right? So everybody's Social Security is different. Anything over 34,000 as a single person is up to 85%.
Mm. That's a lot.
Okay? Yeah. So when people say, "Oh, well, I don't have to file my Social Security," yeah, in most cases you don't, because most people, on average, if you're single, you're not getting more than about that 25. That's like a most people. I'm not saying all people. A lot of people are getting more than that.
Mhm.
But once you're married, filing jointly, that's when you're definitely going to see taxes when
Mm.
it's married people,
Okay.
because now you got two people get Social Security,
Gotcha.
two people. So you got two people putting together. Now the numbers are a little higher, but it ain't much higher because you get up to 50% between 32 and 44,000.
Mhm.
That's not hard at all. So you can at least say a married couple, no matter what married couple it is, they're usually going to be taxed on their Social Security because they're combining the income. Up over 44,000 is 85%.
Okay.
Now you combine that with your pension. See, it's I think it's become because I used to kind of believe that too. Oh, they don't have to file taxes. Oh, no, they do and should and should
You
and
better
should
do it. You better do it. or
and
or save yourself the trouble and just roll it over into an annuity.
right.
Cause now you don't have to
Exactly.
worry about all the extra stuff. It's tax deferred and it continues to grow.
Mm-hmm.
Where the pensions and the 401ks or whatever, those deplete over
Right.
time. Now, I
Mm-hmm.
do know a federal, like one of our clients, I think he said he had lifetime income with his pension. He got it through the army, military. But
Right.
I'm not sure if they're all designed that way,
Mm-hmm.
you know. Um, so I tell anybody, if you have a pension, if you have a 401k, and that's all you have, go ahead and roll it over. Get it,
Right.
yeah, so it be tax deferred before you go into retirement. I think with the pensions, you got a 60-day window from the time of retirement. After that, you will get penalized.
Mm-hmm.
Um, but then
Yeah.
too, if you don't use up all of your annuity when it annuitizes, meaning it becomes active and it starts producing you that income every month or every year or every quarter, um, then let's say you pass away, the growth of it that to continue to grow and accumulate, what's left is become has now become your life insurance policy. So it goes to your
Yeah.
beneficiaries. So, there are some benefits to that annuity option, versus
Mm-hmm.
just leaving it as a pension or a 401k, so to speak, right?
Mm-hmm. Absolutely. I mean, I love annuities to be honest with you. I learned about those when I was doing insurance.
Yeah.
like I said, that's a glorified savings account. When that money is gone,
It's
it is
gone.
gone. If you're not
Yep.
putting no money in there, it's not making no money as you're removing that money out. So,
So you say your mom had an annuity and it wasn't really growing a whole lot?
wasn't wasn't losing any money.
Oh, losing. Oh,
It,
okay, okay,
yeah,
okay.
yeah, no, 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 just wasn't losing, but getting like withdrawals, but not it's not going down. But the
Right.
total
Because it's still
value,
growing. It still
yeah, it's
grows.
still growing. Yeah, so the value is still staying the same. So let's say I don't know the numbers, just hypothetically, let's say 200,000 in there, right? And they get pension checks for years. They can still around 200,000 still.
See,
You know,
and that's
so we're
because
talking
it's
about
lifetime
over a
income.
decade. Yeah, so that's what I mean. It's not moving in a good way.
Right.
Because if you can withdraw, getting a check every single month, and your your total stays the same, that sounds like a win to me. I don't know,
It's
but
not, but I mean, and why not? Because here's the thing: the
yeah,
difference between, let's say, um, you're an older person, you don't have a life insurance policy, right? You say, well, I
mm-hmm.
need somebody to bury me. I need a life insurance policy, and you also get a pension or a 401k.
Right,
So my thing is, why not just dump that money out of your pension 401k into your annuity? It provides you income versus you getting a life insurance policy where you paying towards it every month. It's the reverse.
mm-hmm.
Cause she don't pay on that annuity. It's paid for.
Don't pay. No,
So she don't have to come out of her pocket no more. She put in
no, you
that
don't
lump
pay on
sum
that
of
no more.
money, and now it's just taking off. It's doing
Right,
what it's doing, paying her every month. And after, like you said,
yep,
it doesn't change. The balance is still the same, and she's getting the check every
right,
month. So when she passes
right.
away, that's $200,000, theoretically speaking. That's going to be inherited to you as a beneficiary.
Yep,
That's
that's
like
how those work.
that. That's
Yeah,
com. That's
as
like
a parent.
duh.
Mm-hmm.
But
Right.
that's what this whole webinar is about. So because a lot of people are not familiar with that concept.
Yeah,
You
yeah.
don't
I
hear
don't
a
think
lot
a
of
lot of
people
people
talking about
are familiar
annuities.
with that. Yeah, because most people I talk to, they don't really know much about the annuity. Know about the 401k because it's been pushed on us.
Yeah.
Pushed and pushed and pushed. Um, but it's not really where you want to be. I
Mm-mm.
mean, it's nice to have one, I guess, because the company matches it or whatever. That's cute, but it's not gonna do much for you in the future.
No, it's
Um,
not. No,
you might get a good strong 10 years out of that if you're lucky,
that's it, girl.
and
So
that's about it.
then you got the other option if you don't do the annuities, and if you don't already, well, you can consider, if you're a good candidate and you qualify, to put your money into an IUL. Now, this is
Mm-hmm.
not one of those situations where you can literally roll it over into an IUL like you can with the annuity.
Yeah.
You can't do that. You have to surrender a portion of it, pay the
Yeah.
taxes on it up front, where in the
Mm-hmm.
annuity is tax deferred. So in this case, you're
Yeah.
paying your taxes up front, but you got a lifetime of tax free money coming in.
And now you be on back.
Yeah. So where in the annuity you paying your taxes at the end of it all, where your
Mm-hmm.
bracket might be at 12%. Here
Right.
you will be paying your taxes up front where your bracket is 24%. Now you got people who might look at that as an advantage, right? Because then they'll say, well, I'm making less money. I don't want to be taxed, whatever, you know, where if I was taxed with an annuity of 12%, I'm still getting taxed. I don't want to be taxed, period. Because I'm not making as
Mm-hmm.
much money. I get that.
Right.
I get that.
Mm-hmm.
So what happens is they say, well, let me just get a max funded IUL, right?
Mm-hmm.
So they get the
Right.
IUL, they roll their money strategically into an IUL for a 5 year period or more. But the point of the matter is you're dumping lumps of money into it initially to help reduce the cost of the policy and all the administration fees. And then once you've done that, kind of like a mortgage. That's why I
Right.
always tell people, if you think of it like a mortgage, you always hear that if you pay that extra mortgage, it's going to cut down so many years,
Mm-hmm.
you
Some
know.
years, right? Your
So
interest.
there
Mm-hmm.
you go, same thing. So it's
Yeah.
like it's the same scenario. You dump all this money into it for the first few years, never messing with it, just dump, 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 and then you don't
Mm-hmm.
have to pay on it anymore because
Right.
now it's taking off, it's producing, at a high interest rate. All the administration fees are pretty much paid off. So all the money that has built up in your cash value is now just becoming like a cash cow for you. It's paying
Right.
off the policy. It's growing rapidly with the
Mhm.
stock market. You're not going to lose money because of it being indexed. So if the market falls, guess what? Your money is at a floor of zero.
Mhm.
And you don't have to worry about
You gotta worry
the
about losing.
loss. Right. You just
Now losing no money.
focus on the gains. Because, let's say you are
Mhm.
capped, you have your stock option set where you're capped at 7.25% or 9.25%. The market might go up to 7%. And then you got some stock options where it's not capped. So you might actually get up to 12%. You know, in some cases might be a little bit more. So, anyways, I say all that to say, not everybody, because at the end of the day, it is still a life insurance policy. So you do you do have to qualify, and you
Mhm.
got to go through all the medical screening and everything if you are a certain age and you got some things going on. If you're not extra healthy of a certain age, but
Mhm.
ultimately it gives you the death benefit. It gives you that value in your cash value, get growth. It is
Mhm.
tax free. That it can provide you a retirement income for a lifetime tax free.
Yeah.
So it has some great potentials.
Mhm.
So those are some options. You got the IRA, you got the annuities, and you
Mhm.
got the IUL. But then like for the
That
401k
sounds
into an
good.
IUL, just real quick on this slide, it just says the index universal life combines a life policy with a cash value growth. The cash value may grow based on the market index performance. Potential tax advantage income if structured properly, and that's that max funded. And yes, it does include a death benefit, and yes, in some cases, it will require underwriting, and therefore it could involve higher costs. So, what will I always preach to people? Get your policies early. Early, 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 early. Don't wait
Mhm.
until you're old. Your age is going to make your rate go higher. Believe it or not, men are higher
Mhm.
than women. So that's a factor. And then if your health is
Yep.
deteriorating, even if you had a car accident and you're disabled, that matters.
Mhm.
Guess what? If you had a DUI, that matters.
Oh, I
So,
can imagine because you're high
because
risk
you're at
now.
high risk now. Yeah. So
You're
it's
high risk.
best. And,
What
and,
about
and
this?
the question some people ask is like, how early can I get an IUL? You can literally have an IUL for a newborn at 2 weeks old, 14 days.
Really? I
Yep.
didn't even know that.
Yeah, girl.
I don't know why IUL just sounds so adult.
It does sound so adult, but yes, children at 14 weeks of age can
Oh,
have an
okay.
IUL. That is so much better than waiting until we are adults.
Mhm. Yeah.
Way
You
better.
got a big head start.
Yeah, a
Big head
major head
start.
start. And it's a lifetime. So why not?
Yeah.
So I did an illustration for Kids and Giggles, and it was for a 21-year-old, right?
Mhm.
Pretty healthy. I did a max fund IUL
Mhm.
with basically $1,000 saved a month, which I know may sound like a lot, but if you're young and you don't have any major bills yet,
Right.
capitalize on it.
You can do that, especially if you're
Capitalize.
living with your parents still. Oh my
Yep.
goodness.
So you staying with your parents, you don't have no kids, you don't have no husbands, you just
Right.
working for
You
you,
winning. You are winning.
winning.
You
Because
do
and
that.
a lot of kids will be like, "Well, I need that. That's for old people." No, ma'am. No, sir.
Oh,
You need it because you're gonna get older one day, and you're gonna want a house. You're gonna want a car. You're gonna start a business,
that's right.
and you want tax-free money that you have accumulated that belongs to you. You don't have to get a
Mhm.
loan. Your credit score don't have to be 800.
No,
You don't have to
it
pay
can't.
nobody back but yourself.
That's right. That's it. That's it. And you don't have to pay taxes on debt.
In,
Ish.
in that part. In that part.
Mhm.
There's pretty much.
Said bye.
Okay. So the next step is ta da da review your current 401k plan and your options. Consider everything you've heard in this webinar series from Courtney about taxes, about your options to rolling over your 401k or leaving it. Um, so evaluate your financial goals and needs. Did we even talk about the precautions of
Believing?
leaving it?
Not really.
I
But
don't
I mean,
think
I
we
guess
touched
it's
on it.
kind of self-explanatory. I mean, you can leave it because most companies, like like with my situation, they got rid of Fidelity, but they just went with another company. The only thing with leaving it, usually you don't have a lot of, well, you don't have a lot of flexibility
No,
anyway.
you don't.
As far as what you can, I guess, invest in. Let me put it that way. So, and then of course, when it's another company, you don't know what kind of fees they got. There's a lot of unknowns, so it can be a little scary.
Mhm.
But you can just leave it where it's at,
Mhm.
because it got to go somewhere.
Mhm.
But yeah, that we didn't touch on it, but that's how quick we did.
Yeah. I had a situation where we had a 401k. I left that employer, went to a different employer on my own. I
Mm-hmm.
wasn't terminated. I just, quit and went to explore better opportunities.
Mm-hmm.
But I was young and 401ks wasn't like a major thing for me.
Yeah.
Um until I got older and I was like, "Hold on. What happened to my 401k with my prior employer?" Right?
Yeah.
Then I
Mm-hmm.
reached out to HR and they informed me that after I had left, they had changed, like you said, companies who were handling their 401ks. And they didn't change once, they changed twice because so
Mm-hmm.
much time had gone by. They couldn't
Yeah.
even find it. I had an account number that I had found in my paperwork. So I had my account number and everything. And
Mm-hmm.
I asked them, based off their account number, could they find it? They could not find that 401k girl. It took almost over a year for them to find it.
And they never notified you
No.
because they're supposed to notify you every time another company takes over.
So, and that could be too, they probably didn't have an address because I moved.
Oh yeah, you move.
Yeah. So,
Unless you forget everything, and then you know how that
you
goes.
know how that goes. You don't always
Yeah,
get everything when forward.
yeah,
Because I still get mail from people who don't lived in this house and they're not here no more. So, but yeah.
right.
So, so the option of leaving it is okay,
It's
but it is
okay,
a
but
risk.
why not just move it yourself and control it and see it and put your hands on it?
Put your hands on it because
Yeah,
you risk
that's
the
what I'm
fact that you be like how I was and they can't find it.
saying.
But then too, like you said, is there's no flexibility because you
Right.
can't control the options. Now, I'm gonna throw this out there real quick because it is a little financial strategy that I like to teach my clients. Because one of the things that every client I have may want life insurance, but they're not ready financially. So one of
Mm-hmm.
the things I do is I teach them strategies and I give them tools to prepare them for when they're ready for a policy, particularly an IUL, because they want that beautiful cash value account that comes with it, right?
Of course.
So one of the things that I teach them, and I'm throwing it out here on this slide, um, as like a freebie, um, when it comes to contributions of your 401k, I like to teach people the rule of 50/30/20 or 50/40/10. I'm pretty sure if you're familiar with accounting, you've heard of that before. People will
Mm-hmm.
say that the 50 portion is your needs. 50% of your income is what you
Mm-hmm.
utilize for your needs. And then they'll tell you that 30 or 40% is for your wants. But I don't teach that. I teach that 30 or that 40 is your savings.
Mm.
And that can consist of a lot of different things, meaning your 401k, for instance. You
Mm.
literally can change your contribution off your checks, and this is pre-taxed. So
Mm-hmm.
you can say instead of me just doing the 6% because my employer will only match up to 6%, I'm not going to do no more than that. Well, you're doing yourself a disservice, basically.
Yeah.
You really are. It's a benefit to have them match anything, but it's not their responsibility to have your retirement grow as yours.
That's going
So
down.
I tell people look at your budget, how you spend your money first, cut back on all the unnecessary spending, and put 10% at
Mm.
minimum into your 401k. So
Mm-hmm.
if they're matching you at 6%, well, that's 16%.
Yeah.
So, and if you can afford 20%, do 20%. I wouldn't do more than
Mm-hmm.
30 unless you just like that.
I,
But
my man told me, he was like, yeah, I'm putting, I said, what?
girl,
He said, your wife made some good money, because how you, your whole check bag up.
okay.
You put
But
30 in there. I
if
was
you
like,
can
oh,
do 30, you're doing good.
yeah.
But
Mm-hmm.
remember, and like for the people out here who don't know, what that does, it reduces,
Yeah.
and you can vouch to this, Courtney, it reduces your taxable income.
Yeah. Well, because you get a deduction
Mhm.
for your retirement
Mhm.
contributions.
See,
Correct.
so it's a
Mm-hmm.
good strategy. And I always
Mm-hmm.
tell people tax minimization, learning how to legally reduce your tax liability is a strategy. That's one
Mm-hmm.
of those strategies. When you
It,
maximize your contribution in your 401k, and then
mm-hmm.
when you also contribute to other things like a college savings plan for your child, that
Yeah.
529,
Mm-hmm.
or custodial account with Fidelity.
Mm-hmm. That help your state taxes for those who don't live in Texas and all the other non-taxing states.
There you go.
But yeah. Mm-hmm. It does. It definitely does. The
So,
taxes and all that plays a big role together. They play hand in hand.
yeah,
You got to have them both, and they got to work together to come out with the best solution. You
exactly.
are right. But I like that idea
Yeah,
to
so
move to
that's one of
the
those little
savings.
freebies I threw out there because
Mm-hmm.
because that's one of
Okay.
the things that people need to hear. How do I get to that point? Well, that's how you get to that point. So,
Yeah.
next step, of course, comparing your tax and your financial impact of what to do with your IRA 401k, and work with a professional like my sister, Courtney Davis. She's the owner
I
of
get
Three
together.
Kings, Three Kings Tax Services. Been doing it for a very long time. And she can help
Mm-hmm.
you from a personal and a business standpoint. She helps me and my husband, and everybody. Lord knows I be throwing people at you left and right. I know.
Mm-hmm. You
As a
do
matter
be
of
like,
fact, I got another person that wants your information. She was like, Leah, I need your sister information. So I be
you
sending
be
people
right
to you
there.
left and right. And
Mm-hmm.
then, of course, if you want to talk to me, Leah, I'm the owner of Rose Gold Signatures. Again, I specialize in the life insurance industry and estate planning and financial strategies. So, you want to speak and work with your professionals, to help you make the best decision for your future, then the contact.
But she's gonna finish it though.
I'm telling you. So here's the disclosures. We want to throw it out there for legal purposes. This webinar is for educational purposes only. We are financial advisors. We are not, excuse me. Well, in a sense, I will call myself a financial strategist, but we are not legal representatives. I don't know why it says that we are, but we're not.
No, I
That
don't
threw
hear
me
that.
off. um, Investment and insurance products do involve risk. All right. So, of course, like I said before, consult with a licensed financial professional and tax advisor before making your decisions. I am considered a licensed life insurance agent. I do provide people with products of the financial industry. I like to say that I am a financial strategist. Um, Also, like my sister pointed out, I am a South Carolina commissioned notary public. So I notarize documents, especially those trusts, those will and testaments, those advanced directives and power of attorneys and estates. So if you need your assets protected, I'm the person to help you with that. And then my sister is your tax advisor. So before making any decisions, she can help you with all those preparations and planning. She knows a lot about tax laws and retirement regulations that also may change.
Yeah, I'm still talking about that binder.
Girl, listen, I need to do a separate video on that binder for the estate planning for real.
Girl,
Call to
it's a
action.
sister sister, y'all. That
Um,
binder is everything.
that binder is that estate
And
planner, that binder, and
estate,
look,
yeah,
it's
yeah.
personalized, It's
Yes, I love that.
customized to fit the client and their needs. We're gonna put it out there. So
That's
if you
right.
want a
Look.
binder, an estate planner, call me. I got you.
Mm-hmm. And you know, I have to always talk about that bind everywhere I go. Don't keep asking about her binder.
You so funny, girl. We thank you for attending this webinar. You can visit our website. Well, I say our website because I do advertise my sister's business on my
You do, and
website.
I need to get my. She got a.
Yeah,
Well,
I
she's
do
pretty
advertise
good.
her verbally and everything I do. I'll be putting her all over it. So if you have any
Mm-hmm.
questions, educational videos, or consultations, you can go for those things to my website because I have all that on there. Also, if you want to follow up with a personalized retirement planning discussion, we can do that for free, a free consultation. And just send us some your information. You can send us a message, call us, or whatever, and we can get you on the schedule. For tax planning or tax preparations, please contact my sister at Three Kings Tax Services. But this is a recorded presentation, so we don't have questions and answers. I think kind of between our conversation, we may have answered some questions that could have arisen.
Mm-hmm.
But
Possibly.
if not, we do have another webinar coming up. I think next week with Kevin.
It might be. Did we decide a date? I can't remember.
There is a date, and it's
Well,
on the flyer.
you know, it might be. I knew about this date, one day at a time.
Girl,
So,
I know, right? I know. We can only focus on one at a time. One at a time.
one at a time, one at a time. But I'm sure